Welcome out tonight to the general membership meeting for February. We have a great class today. We're going to be going over some very important changes to the tax law, and that's the main focus for tonight. We're also going to be talking about some parking issues that we've received several questions about. But first, Paul asked me to go over this briefly with all of you. This is a presentation we put together for one of the board committees here in the UAA just the other day, and he liked it so much he asked me to show it to you really quickly. So, let's just go over briefly what are the benefits of membership to the members of the association. The first thing I want to show you is this video that we put together explaining what we do.
So you own a rental property. Get it rented, collect the money. Pretty easy, right? But wait, there's more. You gotta get the home rent ready. You have to advertise. Next, you have to show the house to prospective tenants, screen these tenants, and finally, move them in. Okay, now you're done. Well, let's see. Now you have to inspect them, deal with repairs, collect rent and deal with late payments. And at some point, you have to move these tenants out and do this all over again. This seems like a lot of work. But wait, there's more. There are also risks involved, like fair housing issues, insurance liability. What if someone moves in 3 pit bulls when you've agreed upon a Pomeranian mix? There are also legal risks involved, like habitability issues, and financial risks that include property damage and legal costs. Let's face it, you need help. Utah Apartment Association, the expert on rental housing in Utah. Whether you own one rental or thousands, we have the resources you need. Our rental agreements and screening services help you manage property smoothly. Our publications and trainings keep you current on critical rental housing issues and challenges. As the expert in rental housing, we know the best practices, tactics, and vendors that will lead to your success. We protect owners and managers from abuse of government fees and regulations, and advocate for fair and balanced laws. Utah Apartment Association. Join the association for rental housing and tap into the resources that will make you successful.
How many of you have seen that video before? Okay, it's on our website, main page. If you want to show it to anybody, if you want to link to it, send it to anybody who has a question about who we are, what we do, it's right there for you. Really quickly, as you walked in over by the soda, there's this benefits of membership or membership association overview packet. This just goes over what I'm going to talk about really quickly here and the things that we do. But here are the main services we provide to members. And as members, I hope you're either taking advantage of this or at least know it exists so that if you need it, you know where to get it. First, the forms. And foremost among these, the lease, the application, eviction notices, move in, move out form, and the other forms. Now our class a month from now is going to be about the UAA forms, also about the changes in the law that's coming up. But these are one of the huge draws to the association, is these legal forms that we get. We update them regularly. We changed our lease actually just a couple weeks ago. And we are looking to make sure that our lease is the best in the state. And if it's not the best in the state, because something's better, we go out and we add it to ours. We also do discount background checks as one of our other huge services that's wildly popular. $25 for a combined credit and criminal background screening. That's the cheapest in the state. It's cheapest because we get discount for bulk buying as members of the association. UAA website is another huge resource I want to just show really quick. Here's the website. One of the biggest things is all of the things available under the members tab. So you go under members, you have to log in. I'm currently logged in. You'll see things like, here are all the forms, which you can print out as many as you like, and you can fill them out online. We have some property maintenance tools available in there so that you can use. We have a series of 5-minute videos answering basic questions that landlords have asked. We have, go back, we have available all of our publications available online. So if you read something in a magazine, you threw it away, and you're trying to remember what it was, you can go back in here. We also have all of these classes available right here in the general membership meetings. You can go in and you can see, if you want to, you can go in January's class right here and watch the video from it. So we have all of those available on our website, plus many more things. So if you haven't been on the website recently, I encourage you to go poke around, look at it, log in. If you need your login, call me up and I'll be happy to get it set up for you. But look around and see what we have in there. Next, we have our publications, the Rental Housing Journal, which is our local statewide newspaper. We have Units Magazine, which is a National Associations magazine. Plus, we have our Landlord Guide, which we publish annually. It's a basic overview of the best practices for landlords. And our Membership Directory, which is a valuable resource to find vendors who can help you. This year, we're also beginning to publish a Utah Landlord Handbook, which will be a 200-plus page comprehensive overview of the laws impacting landlords and what we feel will be a good resource for landlords. Of course, the staff hotline, you can call us anytime. If you have questions, if you need help with anything. If you just need reassurance, because that's a lot of the calls we get is, I think this is what I'm supposed to do, is that right? We're happy to help you. That's why we're here. That's why you pay us. Advocacy, of course, and we'll talk more about that next month when we talk about what happened at the Capitol this legislative session. But that's a huge part of what we do, especially our director, Paul. He spends a massive amount of his time working with the state and city governments on issues directly relating to how your business is run and the laws impacting it. Education. We have these meetings, which are a fantastic resource, especially because they're free. We also have the Good Landlord Classes, and we have the UPro series. The UPro series is something we recently launched. It's an in-depth, college-level, 32-hour course on how to be a landlord. It's done in 8 4-hour modules. Okay? And each class is independent. You can take them in any order. It's $3.99 for the entire series, or you can take individual classes if you would like as well for $59. It has some of the best information on Utah-specific laws, on regulations from the real estate division, also on things like marketing, investment, things that are tuned to the market here. And my personal favorite class, maintenance. Learning how to communicate with maintenance guys, tell them what's wrong. You can save tons of money if they know you're educated and if you know what the problem is. So if you're interested in the UPro class, one of the things that we're doing this year that's huge is we're launching evening classes. So on your way out, if you want to pick up, there's a little half-sheet size schedule of the classes. And if we run out, you can look up, call me, and I'll be happy to give them to you. So we have the UPro course. You can see what's involved in that in the trifold handout. But also, we're going to be starting in March, have evening classes. So if you can't make the daytime classes that we've traditionally taught, you can come from 6 to about 10 p.m. once a week. We are scheduling those, I think, now for the second Thursday of every month. Networking. We have tons of events, ranging from our golf tournament to our trade show to classes like this. We have opportunities for you to meet vendors, but especially to meet other landlords. Because honestly, you have just as good of advice for each other, or perhaps better than I have for you. So it's a great opportunity for you to meet, to discuss, to raise questions, and things like that. So if you're interested in coming to one of our events, our economic conference in September, our trade show in June, we would love to have, it's in April. We'd love to have you come. And then last but not least, this is another new thing this year. If you are a current member and you refer a new member, tell them to tell us your name, because we will give them $25 off if they're referred by a current member. We'll give you a $25 gift certificate that you can use for anything from the UA, including next year's dues, and we will enter you into a drawing for our cruise. So it's going to be a fantastic opportunity, and I'm going to hand out the information on the cruise right now. And then in the meantime, I'm going to get ready for Paul and turn the time over to him. So, actually, you know what? He's in his office. I'll hand this out in a moment. I'm going to go straight on to the parking, if there's no objections. All right. We've been asked several times to deal with issues with parking in this class, some things that will be helpful. So I'm just going to go briefly through some of the things questions we've been asked. If you have other questions, please feel free to bring them up. First, what can the cities require of your rentals in terms of parking? And it's pretty basic. Generally, it's the exact same thing they can require of owner-occupied residential houses. They are that you comply with street parking regulations, not allow parking on non-hard surfaces, and no unlicensed vehicles in the yard. So like I said, it's the same thing for owners as for renters, but here's the rub. If the renters are doing something wrong, they're going to come after you to enforce it. So you get to be the good bad guy who goes out there and says, you have to fix this or else I'll evict you because I'm going to be charged for these violations. The second question we often get is, what do you do about an abandoned vehicle? The tenant's left. They've been gone 6 months. We'll have a new tenant moved in, but there's a car sitting there. Yeah.
One of the statements up there was parking not allowed on a non-hard surface. Is this a city
Cities.
law?
Yes.
If you're in the county, it doesn't apply?
It depends on the city or the county, what their rules
What do
are.
you know about Salt Lake County?
I believe Salt Lake County does not like it, but they don't enforce overly. So if you're parked on gravel, you're fine. Concrete, asphalt, something like that. Even hard-packed dirt, but they get really upset if you're parking on sand or something that's going to erode and sink the car in. All right? Or grass. They get really, really upset about tenants parking on grass. Or anybody, for that matter. Great question. Thank you. So, abandoned vehicles, what do? Give 24-hour notice and/or call a towing company. You can give the notice and then call the towing company, or you can just call the towing company and they'll come out and put the notice out. There are complicated laws on once they've towed it, what they can do with it, how to contact, blah, blah, blah. The best resource is just let them take care of it. All right? They'll help you with that process. If you need a towing company, call us. We know some that can help you.
Back up.
Sure.
Call the towing company, who pays?
The towing company usually will not charge you because they're taking this abandoned vehicle and they're going to impound it. And either the tenant will come pay for the vehicle from them, or it will sit there long enough that they can claim it and sell it, and then they get profit from it. So usually you don't charge you anything for that. They're hoping to make a good profit off it.
And another question,
Yeah.
what does it mean, give notice?
So you just have to put something on the car. What do you do with unlicensed or inoperable vehicles? You give a 3-day comply notice to the tenant, telling them, hey, you have to comply with your lease, which the lease should say you have to comply with city regulations, because they're breaking city regulations there, and then call a towing company. Have them take care of it and get rid of it. All right, how many of you do assigned parking at your rentals? Oh, question first.
I got confused. Which thing is 24-hour notice and the other one is 3 days?
Abandoned is 24 hours. And then the unlicensed or inoperable vehicle. If it's broken down but the tenant still lives there, then you give them a 3-day notice to fix it. How many of you do assigned parking at your rentals? Divvy out? Who decides? Okay. Yeah. How do you do it? It's a question we're often asked. Just put it in the lease. It's really that simple. There's a little spot in the lease, line items. Unfortunately, it can be complicated if you have a large complex. Say you have 8 units and you decide you want to start assigning parking. What you do is you start putting in the lease. Once everybody has this in their lease, we'll start assigning parking. And then when you renew everybody's lease, you make sure that's in there. And once everybody has that in their lease, now you go ahead and assign it for everybody. All right? It's unfortunate, but it's a tricky way of doing it. It might take you a couple months or even a year to get to that point. But you just put it in the lease, make sure it's there. What are the advantages of assigned parking? Well, cuts down on some of the conflict between tenants. And one of the biggest things is if there is conflict, you have a really easy way of getting out of it, which is, if they're fighting, you assign the parking, and if they keep fighting, you tell them to work it out amongst themselves as adults. So here's the trick. If you assign parking, they're renting that space, just like they're renting their house. If their neighbor tenant walks into their house illegally, breaks in the middle of the night, they shouldn't call you, they should call the cops. Because they're entering their property illegally. Same thing, if they're parking in their spot that they're renting, then they have a right to call a towing company and have it towed. You don't have to tow it, you can just have them do it. Yes, sir.
I have units that I have, the complex was originally designed as an apartment complex, but the city allowed it to be broke up into multiple units. So I've got a shared parking lot. There's one area, no specific, anyway, it's not broken up for this unit, If I have issues from other buildings parking in what should be my spots, can I have them towed?
talk to the owners. Hopefully you can come to a reasonable agreement. Is there a condo association, HOA or something like that over it? You just talk to the other owners and figure out who fixes the parking lot if it breaks.
It hasn't been yet.
Okay. Talk to them and see if you can come to an agreement about that issue for when the future, when it runs down and it needs to be repaired, but also work out an agreement for that.
What about if visitors just came and everybody knows his spot? And the visitors came and just parked the car on the wrong spot, and the owner came late and the spot is occupied and they don't know what to do, and they calling me or
Yeah.
they complaining. Is there any time limitation for them to call police and tell, hey, they just occupied?
There's no time limitation. You do have to have a sign up if you have a sign parking saying there is assigned parking, please only park in your assigned spot. If you have that sign up, they can tow if it's been parked there 5 minutes.
And if the owner of the vehicle, whoever
It's mad.
complains, would they be responsible or me?
They would be, because it's their spot, they called the towing company on it. If there's any problem, they have to work with them. You're completely out of it. It's not your responsibility to call the towing company, and it's not your responsibility to babysit anybody. They're all adults, they should take care of it.
Because usually the towing company asking, are you owner of the building?
Yeah, and if they ask that of the tenant, tell them to say, no, I'm not the owner, but I rent this spot, and the owner has told me I can have it towed if,
And they would do it.
yeah, they should do it. If they don't, tell them call us, we'll explain the law.
Okay.
And that is it for the parking. So while I hand out the information about the cruise, I'm going to invite our main speaker to come on up. And Charlotte is going to talk to us about taxes. All very excited. I know it's an interesting topic, but it should be very good.
I'll try to keep it somewhat interesting by using examples and things like that, but there's no way to make taxes not complicated. Did you have a liquor thing?
Oh yes, it is. It's sitting right on the stool.
Okay. And, okay. First thing, I'd like to ask a few questions of you guys. Can you hear me? Everybody? Okay.
Should we get the mic out? We can try it again.
Yeah.
Yeah.
Let me get it out.
If there is a mic, it'd be good to try that. Next question, who owns more than 10 units? Anybody? About 4 or 5 people? I won't ask you to answer this question, but some of the rules are a little different if the value of your total property is more than $10 million. So be aware that some of the rules will be a little bit different if you run into that circumstance.
I wish.
Yeah, exactly.
Okay, how many people have owned the units more than 2 years? Okay, a lot of people have, okay. How many know what either a Schedule E is or a Form 8825? Okay, Schedule E is where you put the information on your own individual tax return. A form,
You might want to step back a little bit so we're not right under the speaker.
okay.
Ah.
Okay. Let's see. A Form 8825 is if you're set up as an LLC and you file it on a partnership return. Okay, now I don't have to try to talk so loud.
That's great.
Okay, and then also another thing that's important for what we talk about tonight is the concept of depreciation versus a current expense and capitalization. Depreciation and capitalization go together. In the past, it's always been, if you spent a whole bunch of money to remodel, then you would capitalize the remodel and depreciate it over time. You couldn't take it all in 1 year. You take it a little bit over time, depending on what you did. It might be a very long time. or it may only be 7 years. If you expense it, it means you take the expense in the current year. And so most people like to get the expenses in the current year because that means they either pay less or they get a bigger refund. Now, if your income is too high, the amount that you take in losses could be limited to the amount of your income in the current year. But those deductions will carry forward to a future year, and then it will offset your income in a future year. So you still kind of like to collect them up. Part of the reason I was going through that is I realized last night when I was talking to Nora, I was going over people's heads on some things. Okay, the IRS.
Is there a penalty if you did it the wrong way 5 years ago or 2 years ago? In other words, if you expensed a carpet installation, which probably should have been capitalized, they're gonna come back at me?
If you did it 2 years ago, you would have the option of amending your tax return if you wanted to. If you did it 5 years ago, it's closed, and unless they think you're fraudulent, they can't go back that far, because you and they can only go back 3 years. And so it kind of depends on how long you go back. And a carpet installation, I'm guessing they probably wouldn't bother with. That would probably not be a problem.
Something larger.
Yes, something larger they might.
If you were audited, are they looking for something like that? Is that a big deal?
Carpeting is, it's not a big deal because normally you would buy new carpeting if you were going to the trouble of putting it in. In the last several years, you've been able to write off a fair amount of the new stuff that you purchased fairly quickly, and so it would not be a big deal. And they would also have to get into issues now of how much of your place did you carpet, which I'll get into that a little bit later. That gets to be kind of an interesting thing. Okay. These regulations, the IRS has been kind of like planning them for the last couple of years. They issued temporary regulations. They made them final just this last September, and they updated them in February of this year that applies to the 2014. And the update that they did was actually one thing the IRS did right. So they're not always wrong. Okay, and basically regulations you do have to follow, and they're technically required to be on their 2014 return. And the assumption that they made in February 2015 that was good is that if you just plain file your return, they assume you want to follow the rules. Prior to that, you had to actually say, I want to follow the rules, which was kind of an interesting concept. If you have over $10 million worth of properties, you still have to say, I want to follow the rules. We were reading 282 pages to try and figure out these regulations and what we needed to do. And they define when expenses can be deducted versus capitalized and written off over time. They tend to allow you to deduct more things. And some of the benefits have to be taken on your original 2014 return. You can't do them on an amended return. And so you have to actually be aware of it and do it on your 2014 return.
Where can we find the rules and regulations?
I think you could find them online at the IRS's website. And just search the regulations. The main group of rules that you would be looking at would be actually under revenue procedures.
Revenue procedures.
Yeah, revenue procedures.
Or have a good accountant to help you
Yeah.
look at it instead of reading them all.
In the back of your handout, the second to the last page, I won't go into it very much yet. We designed a flow chart to help you make some decisions with regards to it. We'll talk about that a little bit later as we go through more of these slides. And then, basically, if you're under 10 million, they assume that you want to comply from the year 2014 going forward. If you want to take advantage of some of the abilities to fix stuff in previous years, then you have to, they become a little more complicated and you've got to file some extra forms to do that. These rules, basically they talk a little bit about materials and supplies. This is just an introductory slide here. We'll talk more about each of these things. Cost to acquire property, cost to improve tangible property, dispositions of tangible property, and some safe harbors so that you know you're operating for sure in the good. Materials and supplies, and it's been a little hard for me to think of too much in the way of materials and supplies for apartments. I might think in terms of like maybe the landlord provides the furnace filters. And basically anything up to $200 that's like a material or supply you can write off as soon as you buy it. If you buy materials and supplies that are more than $200 for each item on the invoice, then you're supposed to keep track of them and inventory them. Meaning you don't get to deduct them until you actually start to use them. And then this last line I should have changed because basically now they assume you want to deduct materials and supplies up to $200. But a company or someone who has more than $10 million worth of assets has to actually say, I want to deduct materials and supplies up to the $200 amount, which is kind of an interesting thing. Cost to acquire or produce tangible property. And this is one area where the bigger companies have the advantage over the smaller ones. If you have reviewed or audited financial statements, then you have to, you can elect to write off anything up to $5,000 per item. If you don't have those kinds of financial statements, then you can elect to write off anything up to $500. And so the example that I've been giving, and I haven't checked the price of clothes washers and dryers, but say you have clothes washers and dryers in each of your in each of your apartments. Then if you buy a clothes washer and dryer set for $750, then you've got to capitalize it and depreciate it over time. If you buy a clothes washer for $400 and a dryer for $300 and they're separately listed, then you can write them both off. And so but you can't carry that too far. For instance, and I'll use a car or a truck as an example. You can't buy the tires on the truck separately from the cab of the truck, separately from the engine, separately from the transmission. Because they know you're just going to take it and put it together. Okay? And it's per line item on the invoice. Major units of property. You don't have to actually send in your description, but you should have in mind what they are, and perhaps have them in writing, especially if you have anything that could be questionable. Each building is its own separate unit of property. If you have a parking lot that serves several buildings that you own, then that's the one that you probably want to write down and say, this entire parking lot is one unit of property. So that an IRS agent can't come in the future and say, this third of the parking lot is one, this third of the parking lot is another, and this third is another. You generally want your units of property to be as big as possible, but buildings, unless they're connected together, have to be separate units of property. When I first thought about this, I thought of the UVU building, And, I mean, they've really got their building built right for this, because it could all be one. Question in the back?
What if you own a property with 3 4-unit buildings, but the county records it as a single, with a single tax ID number?
It doesn't, these regulations don't really care what the state or the county does. And so you still have to define each building as a separate unit of property. And then the entire land and exterior developments, like the parking lot and signs and sidewalks, you can define as another unit of property. The goal is to have them as big as possible, but unless you attach the buildings together, then they have to be counted separately. Let's see, we won't get into production or equipment particularly. We don't, or, well, for instance, if you bought a lawnmower, then that would be considered a separate unit of property. I don't know, did I tell you, my name is Charlotte Clark. I've been down at Squire and Company for like 25 years, working in their tax department. And Squire and Company is a firm with about 75 employees that work there, probably 45 to 50 of us are CPAs. And so that's my background. Buildings are then further broken down, and these are defined slides, defined ways, into HVAC, plumbing, electrical, escalators, elevators, fire protection and alarm security, and gas distribution. And obviously not all buildings have all of those things, but those are the further breakdowns. And that becomes significant because if you have 4 units in a building and you replace one of the heating and air conditioning units because it got old, wore out, you bought a new one, then you can write off that completely because it's less than 25% of the heating and air conditioning units in the building. A hotel tried to replace all of their toilets and sinks and try to call it less than a third of the plumbing system. But the problem with that is toilets and sinks perform a discrete function, and by replacing all of them, you're replacing too many things that perform a discrete function. So therefore, you cannot write all of them off. If you replace 25 to 30% of them, then you would be able to. If you made a plan, I'm going to replace 25 to 30 each year, then that doesn't work because it's part of a plan. But if, I'll use the heating and air conditioning system again. If your HVAC, you have a 4-plex, and your heating and air conditioning system, one of the units breaks, then you can replace that and write it off. The next year, another one breaks, you can replace it and write it off. If you just plain plan that you're going to improve them all and replace them ahead of time, you could run into trouble.
We
I
don't
just
know.
replaced 3 in a duplex for all of them on one side. Can I write all those off?
3 in a duplex, so it sounds like you probably have 6 on the building.
Right,
You would have to depreciate them over time.
I would.
Yeah,
Okay,
because if you had done 2, you could have written them off.
okay.
The regulations give an example of 30% and they give an example of 40%. They don't give an example in between. And so, but by replacing 3 in a duplex, you're replacing 50% of them.
Okay.
Okay? Let's see. So, one of the things to do is, when you file your tax return, you typically make a list of things that you're going to capitalize and depreciate over time. And so if you have already made that list, take a look at it to see, is there anything that you added in 2014 that you shouldn't have added? And if so, take them off and count them as repairs. Is it now a material or supply? Is it routine maintenance? Will you do it more than once in the asset's life? And one of the strong examples there is resurface a parking lot or replace shingles on a roof. Most likely you will be resurfacing a parking lot every 7 years perhaps if you're keeping it in really good condition. In which case you write off the resurface. If you dig up the parking lot and put it down again, then as long as you do less than 30%, you can write it off. If you do more than that, then you should probably capitalize it and depreciate it over time. And then, did you adapt it to a new or different use? Yeah?
Were you going to say something about shingles?
Oh, shingles?
Yeah.
Basically, if you're replacing shingles, but you're not re-roofing the building totally, then you can write it off. A lot of times when you redo a roof, you're just adding more shingles on top of the other ones, and that would probably count as a repair. But after you've done that once, you've got to take them all off, is my understanding, and then do it again, do it completely again. And at that point, you might need to capitalize it.
And what's the depreciation period?
On a roof, it's over 27.5 years for residential rental. We'll get into a way to help you out with that a little bit going forward and/or in the past. And the other thing is, did you significantly improve it? If you're making it extra energy efficient, that sort of thing, then you need to capitalize it. If you're replacing it with the modern equivalent of what you got 15 to 20 years ago, then that doesn't necessarily, I should say 9 years ago, because when you do it more than once in its life. If you're replacing it with something that's kind of the equivalent, then you would turn around and just count it as a repair. Reviewing, now the next thing that you can do, this is typically for people who have had their property for a long time and have done lots of stuff to it, spent big dollars on it in the past, or had larger repair amounts in the past. Maybe someone capitalized a resurface of a parking lot because they didn't realize they didn't have to. What you can do in 2014 only, on your originally filed return, not an amended return, is you can look at everything you had on the list and decide if it now meets the cost of repairs. And if it does now meet the cost of repairs, you can and probably should pull it off and take the remaining amount that you would depreciate in the current year. So for instance, if in 2013 you resurfaced your parking lot and you capitalized it on your tax return and you're depreciating it over 15 years, you could think about that and decide, do you want to amend your 2013 return and fix it because that was just last year? Or do you wish to take the remainder of that parking lot and write it off on your 2014 return? You can only do that in 2014 on an originally filed return with the Form 3115s attached to it and sending them into Ogden. That typically, the Form 3115, typically in the past we've kind of figured it would tend to increase your chances of being audited. This year we're filing more of them than we've ever filed before, and we figure it will not increase the chances of anybody being audited because basically everybody's doing it. And so that is an option if you see things on the depreciation schedule that are big amounts that you would like to get rid of. And the reason I say big amounts is because If it's only a $700 amount, the additional cost of the $31.15 probably isn't worth it to you, so you would probably just ignore it. But if it's a $15,000, $20,000 amount, then maybe you really do want that deduction in the current year. So
Would that qualify for like xeriscaping a property?
xeriscaping, you mean?
Like you putting cement,
What's that?
cementing,
Oh,
cementing
cementing?
areas?
If it's new cementing, then that's probably an improvement. If it's repairing old cementing, then you're getting into the repair
How
category.
about putting additional parking for additional off-street parking?
That's improving it again, if you're putting an additional, is typically what you would be thinking. Okay, and then another thing is, let's say a couple of years ago, you had to put on a completely new roof on your building. Never in the past could we remove the old roof. Now, we can choose to remove the old roof. And in 2014 only, you can choose to remove all previous roofs. So if you have a roof out there that you put on a year or two ago and you want to get rid of it, you can remove the original one that you had on your building. Now, you do have to keep one roof on your building.
So are you talking roof or shingles?
Basically, if you're just planning, if you have a re-roofing cost on your depreciation
Like
schedule.
roofing, a roof like the wood and all that, or are you talking shingles?
It would be, in this case, it would be either the roof or the roof and the shingles. If you have either one on, then you would take a look at, because kind of like, let's say you re-shingled last year. Perhaps that would be a repair, so you could turn around and write it off. Let's say your re-shingling was massive enough, so it effectively should be called a re-roof, then you would look at how much was that worth when you originally did it, originally bought it, and then write off what you originally bought 10 or 15 years ago. That's kind of gets to be a little bit more complicated to figure out how to do it. The area where this benefits people most significantly is if they decided to add on to their building. So they knock down some of the previous building and then put more on. Because now you can go take out the portion that they knocked down. And so if you did do a major addition to your building, that's the people that are most likely to use this. Or people who are filing the forms anyways, then you can throw that in too. Then, okay, we were talking on the previous slide mostly about ones done in 2014. This slide, it's a similar thing for any that you've ever done in the past. You can consider whether or not you wish to pull them off, which is kind of a creative concept. If you did it in 2005, I think we had somebody who had added on to their building in 2005. And in order to do that, they had to demolish a third of their building. And so we went back and got them a big deduction for stuff they did in 2005, which was kind of an interesting concept.
That's for 2014 filing only. Is that
Right.
You can go back to 2005 and then expense
Right.
that in 2014 only. It won't apply, you can't do that in 2015 or.
Right, you won't be able to do that in the future. You can only do that in 2014 on an original filed return or an extended return, but you can't do it on an amended return.
So it's now, do it now or never.
Right, if you want to go back and pull stuff off. Removal costs. The rules with regards to removal costs have changed. if you're removing something and you're going to put something else in its place that you're going to capitalize, and you get billed separately for the removal costs, then you can take them as a write-off. If you don't get billed separately, you don't know what they are, so you can't take them as a write-off. So if you have contractors doing work for you now, replacing a furnace, for instance, you want to have them bill you separately for the removal of the furnace and for the installation of the new one. But you want to make sure that they're reasonable. I mean, a removal of a furnace shouldn't be 5 times the cost of the installation of a new one. You've got to make sure that they're reasonable. But do ask them to bill you separately. Now, let's say you have 4 heating and air conditioning units, and you buy a new heating and air conditioning unit, just one, and you have 4 of them on your duplex. You can count that as a repair, so then you cannot take the cost of removing the other one, because if you did that, you would effectively have no heating and air conditioning unit on your building. And so you do have to make sure you're left with one of them. But the main thing is, as you go throughout life now, just ask your contractors to bill you separately for the removal costs.
Now, when you say separately, can it be on the same invoice, but definitely?
Yeah, as long as it's line item
differentiated?
different. Uh-huh. Yeah. The reason you haven't heard more people talking about it is because they finalized the regulations in September and then they modified them in February 2015 because they were getting so many complaints from accountants and CPAs about these rules. And so make sure, if you do have major things that you're depreciating that you paid for several years ago, make sure you don't send in your return if you want to take any of them off. And your accountant CPA hasn't considered it, because in about November or so of last year, I attended a presentation, a National Construction Conference presentation, and they said that they had surveyed CPAs and only about 20% of them were really paying attention to these, because everybody else was too worried about the Affordable Care Act. And for people who have rental properties, this could be a huge thing. For a lot of you, if you have a newer unit and you haven't had to do anything to it, it may not make a whole lot of difference. But if you have older property that you've been doing stuff to over the years, then it could be a pretty big difference. And the things that you do in the future, you'll want to consider it differently. To give an example, I have one little condo that I rent out, and a couple of years ago I pulled out the carpet in the living room area, and I replaced it with laminate flooring. Had my nephews do the work, so the total thing cost me about $400. And I thought, well, the laminate flooring is kind of a long-term lasting thing, so I should probably capitalize it and put it on my depreciation schedule. Now, if I look at the same thing, I didn't replace more than 30% of the flooring when I pulled out the carpet and put in laminate. So I could write it off as a repair that way, and since it happened to be less than $500 for me, I could write it off as a repair that way as well. If it had been $800, I could still write it off as a repair because it was less than 30 to 40% of the flooring in the whole condo. So there's little ways that going forward it will be fairly easier. It'll be easier to take advantage of it. And if you had a whole bunch of that sort of stuff with big dollars, it might be worth going back. And it's not an amended return for the going back years unless you want to amend in 2013 or 12. It would be on your 2014 return, the same year that a bunch of other people are doing this sort of thing too. If you're more than $10 million, then don't send in your return without the Form 3115s attached to it. Because you have to include them, and the IRS is expecting you to include them, so you want them there. And the way you know if you have a Form 3115 attached to your return is you gotta sign extra places. That's the easiest way to tell.
Well, conceivably, we've already filed our return.
Yeah, perhaps you have.
So did I hear you say that to amend your return will only work in 2014, but explain
You
that.
can't, if you've already filed your return, you can't go back to previous years to do anything about it anymore. And I don't know that I would amend
So
the
this is
2014 return.
Is this really a big deal?
If you've already filed your return now, but there's probably a bunch of people here.
I have another question. In your
Yeah.
example of replacing the carpet with laminate in your own
Uh-huh.
condo, that's, in order to change that, you have suggested in your paperwork here that the CPA is likely to charge more money to you to make a revision.
Right.
Aren't we
so-
talking about nickels and dimes, or am I just not getting it?
So realistically, it would not be worth it to me in my little condo unit to do that,
To go
other
back.
than to go back and do it, because it wouldn't be basically an hour or a couple hours of the CPA's time. It wouldn't be worth it. But if you had added on to your building and you were looking at perhaps, well, let's say your building was 300,000, and when you added on, you knocked down $100,000 of it, and you still had $70,000 of depreciation left. You could take that 70,000, get rid of it, and it's an expense you've already paid for. You don't have to shell out more money, and you can have that deduction.
Just a full amount on
Right.
left over from the depreciation.
Right. And then going forward, just knowing things like tracking removal costs, how much you actually do have to count as repairs, parking lot resurfaces, roofing jobs, sometimes things that you